Should you tap into the equity in your home to buy another property? I'm going to break down the process and tell you exactly what you need to know to make that decision. If you're considering using home equity, obviously you own a home and you have some sort of equity in the property, either through appreciation or mortgage paydown. You can use home equity for a number of reasons, whether it's to buy a new primary residence, to buy a second home or vacation property, buy an investment property, you could use it to pay off debts, or go on a vacation if you want. Before we get into the details, let's quickly talk about what home equity is. Simply put, it's a portion of your home that you actually own. So if you sold it today, how much would you actually walk away with? After paying back your mortgage, what would you actually walk away with? So over time, as you pay down your mortgage and the property appreciates in value, your equity increases. So there's two main scenarios where you might want to use home equity to buy another property. The first scenario is you're wanting to buy a new primary residence, whether you're wanting to upgrade and get into a bigger, nicer house, or you're relocating to a different area, you're wanting to buy a new house to live in. You can use the equity that you built up in your current home for the down payment on a new primary residence. Most people sell their current house before they buy a new house, but that isn't practical for everybody. I see this quite a bit with people relocating. So if you're moving from another state or you're moving from out of town and you're wanting to buy a new primary residence and you don't want to sell your house until you know you have somewhere to go. A lot of times people will use equity from their current house to buy that new house so they make sure that they're not homeless. Another scenario that I see quite a bit is somebody who wants to buy a new house, but their current house needs quite a bit of work, so they can't sell it yet. They want to move their family out of that house and then complete the renovations and then list the property for sale. The second scenario is you're fine living in your primary residence, but you want to buy another property, whether it's a vacation home, second home, investment property, you just want to use your equity to buy another property. This is a great option because it allows you to use the money that's already working for you to put towards a new property that's going to start gaining you more equity. Now you have two properties appreciating in value. All right, let's get into how you can access your home equity and make it work for you. Imagine home equity is a giant piggy bank filled with cash. The only problem is you can't just smash it open and take the money out. You need to use specific tools to take the money out of the property, and there's three main ways to do it. Sell your house, get a home equity line of credit, or a cash out refinance. I'm going to break down each option. I don't think I really need to explain the first option. Everybody understands what happens when you sell your property. Option number 2 is a home equity line of credit, or HELOC. Picture a HELOC is a giant credit card secured against your house. You can borrow up to a certain amount and only pay interest on the amount you actually borrow. If you have a $100,000 HELOC and you used $40,000 of it to buy another property, you're only going to pay interest on the $40,000 that you actually borrowed. Once you pay back the $40,000, you can use it again. One other quick detail to understand on a HELOC is you're going to have two separate payments. So if you already have an existing mortgage, you're going to have that payment plus the payment on your HELOC. This is a good short-term option, but be careful about carrying a large balance as interest rates can fluctuate and this option can get really expensive over time. All right, option number 3 is a cash out refinance. A cash out refinance is basically getting a new, bigger mortgage and receiving a lump sum payment at closing. It's similar to a HELOC, but you're only going to have one payment, so it can make it a little bit easier to manage. So this is a great long-term option. Interest rates aren't going to fluctuate. You can get a 30-year fixed rate mortgage, and so you can rely on how much your monthly payment's going to be. So this is great for the long-term projects like buying a second home, vacation property, or investment property. All right, now that we've covered all the basics, let's talk about numbers. To figure out how much you can borrow, there's really two factors: your current mortgage balance and the value of the house. Most lenders have a loan-to-value requirement of 75 to 80%. Here's an example. Let's say that your house is worth $400,000 and the loan-to-value requirement is 80%. This means you can potentially borrow up to $320,000. I got that number by taking 80% times 400,000. 320. If your current mortgage balance is $175,000, that means you have $145,000 in equity that you can pull out of the property. So take 80% of the value, subtract out your current mortgage, and that's how much equity that you can pull out of the property. Before you start tapping in your equity, there's a few more important factors to consider. Number 1 is qualifying for the new payment. You have to be able to qualify for the new mortgage payment or the mortgage payment plus your HELOC. So your debt to income has to be able to support both payments or this new payment. Your lender can help you with this, but this is something super important to make sure you have it completely worked out before you start making offers on a house. Number 2 is how are you going to pay back the mortgage or the HELOC? If you're going the vacation property or second home route, consider renting the house out on Airbnb or one of the short-term rental sites whenever you're not occupying the property. I've seen a lot of people use this method to have somebody else pay off their vacation home. If it's an investment property, just make sure that the cash flow covers at minimum the mortgage payment or mortgage payment plus the HELOC. The third is don't bite off more than you can chew. Don't take out more equity out of the house than you're actually needing to use. If you don't have a plan for the money, there's no point of doing any of these methods because you're just going to be paying interest on something you're not using. Using your equity to buy another property can do a lot for you. It can help you grow your wealth. You can leverage against your current property to buy another property that's going to appreciate in value, gain you equity, maybe spit off some cash flow and help help you on your taxes, but ultimately it can help increase your wealth. Or maybe you're just looking for a lifestyle upgrade. You wanted to tap into that equity to buy that bigger, better house in a better area. Maybe it's a better school district closer to your work, ultimately something that's going to improve your quality of life. And it can help you diversify your investments. If you're looking for a tangible asset that you can actually control, then real estate is an amazing option. But there are some risks and downsides. Number one is market fluctuations. So real estate is much like the stock market. It can go up and down in value. It's not quite as volatile as the stock market, so we don't see as big of swings up and down in values, but the real estate market is just like any other market. It does fluctuate in value. So worst case scenario is the real estate market declines and you have less equity, or you end up owing more on your mortgage than your house is worth. But this is super location dependent. It really depends on what area that you're in. If you're in a stabilized area, like I'm here in Lubbock, Texas, the Lubbock market is very, very stable, and we've seen that throughout history, and we can continue to see that. If you're in a more boom and bust area, maybe you're in Seattle, somewhere in California, Arizona, maybe even Florida, those areas see a lot more market fluctuations and more stabilized areas do. And that's why I say don't take out more equity out of the property than you actually need. The second is the increased financial responsibility. So if you're using the equity to buy another property, vacation home, second home, investment property, something like that, you have the increased financial expenses that can go along with that. The water heater goes out, you need to replace the roof, you need to do some cleaning or repairs, maintenance, things like that. There is going to be a cost associated with it, but factor that into your plan. And the third really only applies to HELOCs, and that is interest rate fluctuations. So interest rates are much like the stock market. It can go up over time. Interest rates really mirror inflation, but if we see higher inflation and we see interest rates go up, the payment on your HELOC can likely increase. One option we didn't really talk about in detail is taking equity out of your property by a cash out refinance and using that cash to pay off high interest debt. This can be a really good option. It can really put you in a better financial position. If you look at the average interest rate on the other debt you're paying, so if you have a bunch of credit cards that all have 25% interest rates and you owe, say, $20,000, the interest you're paying on that is ridiculous. So if you can take equity out of your home and use that equity to pay off those credit cards, that can really put you in a better financial position and save you a ton of money a month. And if you want to get a good understanding of down payments and how much you should put down on a new house, or if 20% down is the right move, watch this video next.